Hi, Douglases. This is Tiffany Dawson. Come answering your questions that you were wondering about for the tax strategies for education. So let's begin. You were wondering about if there were any deductions available. So there are student loan interest deductions. It's up to $2,500 of interest per year, and you don't have to itemize on your taxes to be able to receive that deduction because it's taken before the adjusted gross income. There's a phase out though, so if your income, if you are a single parent, which or you're filing single on your taxes, married filing independently, that income is 70 to 85,000. If you're married filing jointly, it's 140 to 170,000. If you receive beyond this point or these amounts, then this deduction is not available to you. The loan proceeds must be used for qualified expenses. So um, you do not make or use the loan for expenses, and we'll go over qualified expenses, what's included later. Then if you don't use it for qualified expenses, then it's not um, able to be deducted, the interest amount. The loan origination fees, credit card interest, and capitalized interest are also deductible only if they're used for qualified expenses. There is loan forgiveness, and this is normally after about 20 to 25 years, but it's considered income for federal and state taxes unless you qualify for an exception, which includes a public service loan, and where your employer qualifies under this, the best thing to do is to contact the agency in which you've received the loans, such as Nelnet or Navient. There's also the teacher loan forgiveness. This is if the teacher normally depends on what subject they're teaching, that if they qualify for this. Also, it depends on how long they've been teaching. So you'll have to, again, contact the servicing agent and figure out if you would qualify for this. There's a law school loan repayment assistance. Uh, Again, contact the agency, and then the National or Nation Health Service Corps repayment. Again, the forgiveness is after 20 to 25 years. It's normally considered taxable income except for those exceptions. There are discharges considered taxable income. Discharges would be included if the school has closed, where you're receiving your education from, if there was a false certification, there were unpaid refunds, or if there's a death or disability involved with you in the process of getting your loan or as you have received your loan. There are two differences, we're talking about the American Opportunity Tax Credit, and then there's the Lifetime Tax Credit. First, the American Opportunity Tax Credit. The difference with this one is it is a credit up to $2,500 per student per year, only for the first year of the qualified expenses. So qualified expenses again would be books, supplies, or equipment for your education. There is also an income phase out, and there's up to a 40% credit that's refundable credit, which is treated as your tax payment. The lifetime learning credit is up to $2,000 instead of the $2,500. It's $2,000 per family, not per student, but there's an unlimited amount of years. So you take the 20% of your qualified expenses, and if it's over the 2,000 mark, then it doesn't. You can't receive that credit. It's only the additional amount. So 20% times your qualified expenses. If it's under the 2,000 mark, you receive all of it. If it's over the 2,000 mark, then you only receive up to 2,000 of a credit. The qualified expenses, again, would be activity fees in that tuition portion, books, supplies, and any equipment that would qualify. The you would be paying for qualified expenses. It can be for yourself or for your spouse or even the dependent. There is an income phase out. So if you are on your taxes, if you're filing single, then if it's above the 68,000, then you cannot receive this credit. If it's above the 136,000, you cannot receive this credit. Qualified expenses, so majority of the time, is tuition, fees, any books, supplies, equipment at the eligible education institution. This does not include room and board or transportation or expenses to get to school or equipment or other fees not required for attendance. There are scholarships available, but as far as the treatment of taxes, the tax-free, they are considered tax-free if you are a candidate for a degree at an eligible location. So if you meet those requirements towards the what the location, if it normally it would be like a FAFSA or FAFSA location, where if you file for that in the education institution, you accept that, then you should probably be able to do that. But double check, make sure that it would work. Also, if you're using the proceeds from the scholarship for those qualified expenses, it will be taxed if you don't use it for those qualifying expenses. Also, if it's a scholarship prize, that amount would be taxable. IRA distributions, if you are using a distribution for education purposes, then higher education, it is subject to income tax, but not a penalty if you're under the 59.5, because normally if you have a distribution from an IRA and you're under 59.5 years old, then you would have a 10% penalty, but not with an education distribution. With IRAs, the contribution amount that you've made towards the IRA is you don't have any tax consequence with it because you have paid after tax dollars. So your principal amount is not taxed if you take that out. The conversion amount is pre-tax dollars when you've converted. So if you withdraw without tax consequence, because it represents the basis, kind of similar to the contribution amount. But if you are taking it out before you've held the account for 5 years, then you may be penalized the 10%. Also, the amount that would be taxed is if you're withdrawn for education, or your earnings amount. If your earnings would be the amount that you've earned on your investments after the amount that you've contributed. But normally that is not taxed if it's taken out for education, but it has to be the qualified expenses. And if not qualified, then the exceeding amount, like I said, would be taxed at the income rate, but there would not be a 10% penalty if it's used for higher education. And I did a typo there. It's not tax-free, it's tax-free. The difference between a UTMA and UGMA, well, not the differences, the advantages and disadvantages. Advantages is that the person who opens the account is considered the custodian, and they can control the account, the investments and income. They can invest in cash, securities, and real estate. However, the disadvantage of the custodian being in control is that at the age of majority, it depends on the state, 18 or 21, um, if the student that, or the student that the custodian opened the account for and put their name on, it's anything in that account, any distributions, it's taxed at that student's, it becomes theirs. We'll put it that way. So custodian opens the account for the student. Student reaches the age of majority, 18, which is 18 years or 21, depending on the state. That amount in that account becomes ownership of that, or the student owns that amount. So if they choose to use that account balance for anything besides higher education, they are free to do so. Um, it's up to them. So if you open the account for the purpose of higher education and the child chooses not to go to school, that's okay. They can use that money however they want to. There is also a possibility of kiddie tax. So if there's unearned income, which would be the account balance, above 2,200, that's as of 2019, it would be taxed at the rate of trusts and estates. And that is all I have for you at this moment. If you have any other questions based off of what we've discussed today, or I've gone through real briefly, then shoot me an email or call me. This is my office number and location. So if you have any questions, we can set up a meeting in person too. Thanks for your time, and I'll talk to you soon.